principal is a one-time payment. At the very, very end, interest is a stream of payments, either typically most bonds are semi-annual. Obviously in the stuff here, unless they tell you it's semi-annual, you have to assume that it's annual. So annual is also not that unusual to do, but it can be either one. So the principal is just a one-time payment at the end of the bond. The interest is an ongoing payment. Okay. So the principal is also called the face amount. So let's say I have a $100,000 bond. Okay. And the interest that it's paying is 6% annually. Okay. We're just going to keep this as an annual bond because that makes it easy. So what that's saying is I'm making a payment of $6,000, and we're going to make this for 5 years. So if you want to think about total cash payments, what they're paying total in cash is $100,000 plus 5 years of $6,000 each, so they're paying $130,000 in total. Okay, 30 of it is interest, 100 of it is repayment of the debt that they're borrowing from the public. Okay. If the public and my rates match, if that 6% matches exactly with what the public is willing to accept, the bond will sell at $100,000. Because the idea is, if I go to you and I say, I have this bond, I promise to pay you back $100,000, and I promise to pay you 6% between now and the time I pay it back, and you're going to go 6% is exactly what I want, then you're going to give me the $100,000. I'm going to give you back the repayment plus the interest. So if I was going to a bank, what you would see on your financial statements is just the $100,000, and it wouldn't change because there's no difference between the interest rates. The problem comes when you're actually floating a bond to the public, in which case what the public wants and what you're willing to pay are usually different numbers. They can be very close. I would suggest you read the long-term debt section of this, and you'll see, it'll give you an idea of kind of where they're at with their market rates of interest.
So it's at market rate when the bond comes to fruition. They're not agreeing on a 5-year term for the bond initially?
No, I mean the 5-year bond that's the contract amount, so it's a set
Right.
amount. So the amount of that market rate of interest is the public saying, based on what you're offering me, am I willing to accept it? And if I'm not willing to accept it, the only thing they can change is the amount of money they're going to give you.
But if if I'm the public and you're the company, and we say, okay, we're going to buy your bond for a 60-month term or 5-year term,
Right.
Now in 2019,
Yeah.
2020.
2020, that's it. 25 years from now, 2020.
So in 2020, are we now? Is it at the market? That's what we're determining, or what?
No. So what we're doing is we're always, whenever I have a transaction, I'm locking it in. Okay. So the market rate is when I initially sell it. When the company initially sells the bonds, they're locking in that market rate.
Right.
Market's going to continue to change. And what that means is if you've got my bond, you may decide to sell it in the marketplace because you've made enough money off of it and you think it's to your advantage to sell at that point in time.
Okay.
Interest rates may drop to a point where it's smarter for me to buy back the bond from the public in some way, shape, or form and reissue a new bond.
Right.
Okay, that's what that fair value, market value is subsequent to that date, which is just what's going on in the marketplace now. That's going to give rise to future transactions. But what we're putting into the accounting records is what transaction has already occurred. And the only transaction at this point that has occurred is the one where I issued the bond to you.
Right.
I don't care who owns the bond, so you can buy and sell that with any other investors in the secondary market that you want.
Right.
All I know is I, as the company, have issued these bonds. I don't care who owns them. I just know that I have a legal obligation.
Right. So they've taken in, from the cash flow perspective, they've taken in $100,000. They know that's concrete, or whatever the bond.
Right. Whatever the bond sells for, they've taken in, that's concrete. They also know what they have to pay back out.
So is it then estimated interest expense, or is it?
Yeah, so basically what we're doing at this point in time is we're saying, once I lock it in, once that transaction occurs, what I know is when I don't get the full face amount, the difference between the face amount and the amount I actually get represents interest over a 5-year period of time.
Right.
So if you can take that difference and recognize the present value of that amount, that's got to be future interest that's going to be paid. And it's estimated, but it's not. It's not estimated because you know exactly how much cash came in, you know how much cash is going out. It's pretty set, it's pretty locked in there. What you're estimating is what's happening in the future marketplace and at what point in time is it beneficial for me to buy back my bonds because the market has changed.
So is that hypothetical contained in a contingency account or like the variable?
We don't care about that. I mean, well, the initial transaction, we have in a discount account, but that's it.
Okay.
We don't do anything beyond that.
Okay.
Okay? Yeah.
So that's where I get,
That's where
with
everybody
the,
gets
with the
confused.
pricing. It's like the original pricing, where there's a discount or premium, and then calculating it, because the company doesn't put the 100,000, they put in their books what they get for the bond.
Right, exactly. And what happens is we can figure out, based on what they get for the bond, what the premium or discount is, which is a representation of the actual interest rate. Okay, so let's say the market rate of interest is going to be, what do we got, 6% here? Let's make it 7%, okay, which tells you immediately this bond's going to sell at a discount, because the higher the interest rate is, the more of a discount you're going to have. So the closer that number is to 6%, the less of a discount you're going to have on that. And the higher that number gets, the greater that discount is going to be. Because what it's saying is, if I'm offering 6% and you wanted 10%, you're going to cut that bond price down a lot, because you're not getting nearly as much interest as you wanted from it.
So the higher the market rate, the higher the discount.
Yep.
is gonna be.
Yeah, exactly. And then if it's flipped, if the interest rate is actually lower than the market, you're gonna have a premium. That's rare. It really is very rare in the real world. Okay, so 7%. We're still gonna have to pay 5 years. We're stuck with that because that's what the contract amount is. Okay. So this is where the tables come in, or your calculators, if you're savvy enough to use your calculators.
So for the tables, if there is a question about this,
I will give you the table. So as long as you can figure that, and it's actually, if you look at the tables, they're basically formulas. So in economics and finance, sometimes they go through the formulas and they talk about why, interest rate is related and the whole bit. I don't care. It's a formula, and the tables are like any calculator. You're programming a formula in so that you're getting something out that's a relationship that's out. It's a set relationship. So, let's see if I can find it. Present value of $1, 7%, 5 years. See if I can make sure I can do this. 5 years, 7% is 0.7130. Okay, this number will always be less than 1 because I'm making one payment, and the further you get out, the further that present value is. Which is always, the present value is you'd rather have money today than in the future, because $1 today is worth more than $1 in the future because of the interest and the passage of time. So this number is always going to be less. So this is now 71,300 would be that amount. Okay. Then we also look at the present value of an annuity, which is just, an annuity is another word for stream of payments. And that one is 7%, 5 years is 4.1002. Okay. If you were to take one of these tables, when you have a bored moment, whatever, if you took if you look at the 7%, what happens is in year 1, it's 0.9346, year 2, it's 0.8734, 0.8163, 0.7629, 0.7130. You can see that that factor goes down the further out you get. If you would add those 5 factors together, you will get 4.1002. because it's as if you made a payment at the end of the first year, at the end of the second year, at the end of the third year, at the end of the fourth year, at the end of the fifth year. So all an annuity table is a summation of individual one-year tables. Okay. Okay. So 6,000 times that number is, let's see, my cell phone is here someplace.
No, no.
4.1002 times 6,000.
24,601.
Yep, 24,601. Which tells you that this would not sell for 100,000, it would sell for 95,901, almost 96,000.
So you multiply the annual interest times that.
Right.
And if you had a semi-annual, do you work to
Then you would take this divided by 2 and your life times 2 if it were semi-annual. So what you're saying is I'm paying 6% per year, but I'm really paying 3% and 3%, so I'm making 10 payments of 3% each rather than 5 payments of 6. Okay, that's all you're doing with a semi-annual bond. Okay. So that's the price of the bond.
number's gonna end up being the same, right?
The number will, it'll be a little bit different because you're compounding a little bit more often,
Okay.
but it'll be close to that number. Okay?
And I know I asked this question before, but I'll ask it again.
Yes.
So the company wants to issue a bond for $100,000 and they're only gonna get it 95,901 for it.
Right.
And this is all back to the contract. Can they get, I mean, are they obligated once they put that bond out there, are they obligated to?
No, I mean, typically what they'll do is they'll go to an underwriter, and the underwriter is offering to sell it. And typically what they'll do is it'll either be all or nothing. Sometimes they'll sign a contract that says you either have to sell the whole bond issue or none at all.
Okay.
Sometimes it's a minimum amount. So let's say they really think they need about $80,000. They may say, okay, we need to get, at least 80% of these bonds sold or 85% of the bonds. And so they'll set up kind of those parameters. So yeah, if they float a bond and it doesn't look like it's going to go, the company can pull that back out based on best efforts is typically what it's referred to as. So there are legal ways for them to pull a bond. If they float it in the market, it doesn't look like it's going to go, they'll pull it back. That's a rarity because most companies know ahead of time what's going to happen. Where that will happen sometimes is when you have like 9/11, where there was a shock to the economy suddenly. Whereas people were thinking, oh, interest rates are going to be up here. Suddenly there's a shock. They may have pulled things back. They may decide not to float the bond issue because it's like, we're not going to get what we think we're going to get. Let's wait 6 months and hope that the market recovers enough for us to try this again.
Okay, so the other question about the bond, on the other side, the people who are buying the bond,
Mm-hmm.
are they all buying at the same rate, or is it everybody buying at different?
Well, they're going to be buying typically at different rates. So
like
this is
A
kind of
and
an,
B?
yeah,
Okay.
right, yeah, and typically it depends on when they sell it and how it's sold. If it's sold as a block, then everybody's playing the same thing, and all they're doing is they're promising what they're doing is they're saying, yeah, we'll buy it at least this price, and then it kind of evens out. Or they can be selling them one at a time. Depends on how it's all set up.
Okay.
Okay, but most of the time, yeah, so this is basically the cash they're gonna get in. The other side of it is they're gonna be recording an investment. The investor on the other side is getting an investment. These guys are recording this. Okay, so this is how the bond is priced. What really happens in the real world is we look at this number, and this is what happens when you look at the BP answer. They'll tell you the cash we got for it was blank amount. So they're saying they got 95,901. And what you know is, you know what the face is, you know what the interest is. You can work backwards on a calculator or on an Excel spreadsheet, and you can figure out what this number is working backwards. Okay, this is a little bit more beyond the scope of what we need to be doing. But yeah, you can.
That's all we need to hear.
But
That's
we're
what- yeah.
not doing that tonight.
You're not doing that one tonight, but you need to kind of understand that in the real world, that's what's going on. And so a lot of times what they'll report is they'll say later, this was what the cash was, and the yield, which is the market rate of interest, is figured out based on that.
Okay, 'cause that's, Yeah, I got confused in the language for this question. It was, the 3.35% senior note was issued to yield, so the yield was the market.
Yeah,
Okay.
yield, effective, or market are all the same term,
Okay,
okay? Okay, so that's what we have in terms of pricing the bond, that's step one.